I've watched some real abominations on to bring on David Sachs to talk about the bank failures is, I mean, and ostensibly from shows that sell themselves as lefty shows is pretty stunning. I mean, some people are just absolute idiots, and some people are just sort of like incredibly shameless in their grift. But don't ever utter the word neoliberal if you could bring David Sachs on to explain to you what should be done and whose fault the banking crisis was. My God.
Pair this.
Do people not understand that the word neoliberal comes from essentially like the original neoliberals were von Mises and Hayek at Mont Pelerin, and
no, it means it's a woman with a shrill voice that I don't like.
It's New Democrats that do identity politics.
It's
when a Democrat's so cringy.
So dumb. And unforgivably dumb. You don't have a politics YouTube show for 12 years and still sort of like justify being an idiot because I do comedy.
Yeah. Well, when he's not interviewing David Sachs, he's going through my Twitter mentions and retweeting replies to me where none of the topics have anything to do with him.
8 years ago, Jimmy Dore was sitting with the CFO of TYT talking about how great David Sachs's partner at PayPal would be in the Supreme Court.
Yeah, exactly.
Honestly, this is full circle.
Yep. All right. But getting on to actually and we've outlined, we're going to outline this again with Dayan. There are multiple levels to the extent that we have a banking crisis, why that's happening. But all of the commentary and all of the explanations as to why there was a bank run, as to why Silicon Valley Bank and other banks of its ilk may be over-leveraged, may be undercapitalized. All of these subsidiary questions are subsidiary to the one simple fact that banking regulations were rolled back and no longer were applied to banks that had less than $250 billion in assets, as opposed to less than $50 billion in assets. And the reason why it was at $50 billion in assets was because if a bank goes under and has less than $50 billion worth of assets, okay, some people are going to get burned, but it's not going to bring down the system. And that's it. Bottom line. Here's Elizabeth Warren at the Senate Finance Committee hearing talking about that rollback, because everything else that we can talk about with the so-called bank crisis is a function of this, and we would not be talking about it. The FDIC takes over banks fairly regularly.
It was like every other week in 2008.
In 2008 was more than that even. But it, even in the course of like everything's going smoothly, they'll do one every couple of months. We never hear about it because it doesn't matter. And SBV really wouldn't have been a story outside of tech bubble circles if it weren't for the fact that there was no regulation on it.
Enhanced liquidity requirements that ensure that banks have enough cash on hand to meet their obligations, particularly in times of stress, capital requirements that better position banks to absorb losses, regular resolution plans to help guide regulators safely through winding down failed banks. All of these were weakened in 2018, and when SVB failed. This is a part, in my view, of the Fed's actions that led to weaker regulation. Over the last few days, we've heard a lot of Republicans say that this collapse wasn't their fault. It was the banking regulators who were asleep at the wheel. And believe me, I have questions for a lot of the banking regulators. but Congress handed Chair Powell the flamethrower that he aimed at the banking rules. In fact, he said so himself, I'll quote and then I'll quit. When he announced that he was weakening regulations for the banks like SBV, Chair Powell said, and I quote, "In the rules before us, we are applying the discretion granted to us by the Economic Growth, Regulatory Relief, and Consumer Protection Act." Translation, Congress opened the door to weaker regulations, and I'm waltzing right through it. That's true. Congress needs to close that door.
That's the bottom line. From 2001 to 2023, like when we were at the height of the crisis in 2009, 2008, 2009, you were getting you had 140 banks in 2009 that were taken over by FDIC.
Wow. So I was lowballing.
Well, in 2010, it was 157. By the time you get to 2014, it was 18 banks. 2015, 8 banks. 2016, 5 banks. 2017, 8 banks. 2018, 0 banks. 2019, 4 banks. 2020, 4 banks. 21 and 22, no banks. This year, 2 banks. The reason why we're hearing about this is because of that rollback. Mm-hmm. Because it's a big bank. And then the other reason why we're hearing about it is because it's all a bunch of tech bros who have access to the way that we create stories now.
And who are using media operations like CNBC to beg for money. And there are a lot of people following suit with that. And
we'll talk to Dayan about this too, because a lot of these people have the phone numbers for Janet Yellen and for Powell and for people in the administration, et cetera, et cetera. And that, of course, Dayan will walk us through this, but essentially they get on television and say, the sky is falling. Mm-hmm. We've got to save the depositors, without really saying like, oh, incidentally, I'm either a depositor or I've got $200 million in that bank, or some of the key elements of my investment portfolio, they have their payrolls, there or something.
And good on Elizabeth Warren for being consistent on, she said from day one, Biden should not be, for bipartisanship reasons, keeping Jerome Powell on as the head of the Fed. She's been continuously critical of him throughout this process. And it's paying dividends now because we hear that he is fighting tooth and nail to get rid of, and Dayan wrote this up, any kind of mention of regulation as a response to this.
We will talk to Dayan about that in a moment.